Okay.
Good evening, and thank you for joining us for the Founders First Fireside Chat for the month of February. I'm your host, Kim Folsom, and we have the amazing, fabulous Miss Kesha Cash of Impact America Fund, and we'll be starting in just a few moments. Good evening. Thank you so much for joining us for the Founders First February Fireside Chat series. I'm your host, Kim Folsom, and our guest panelist this evening is Ms. Kesha Cash of the Impact America Fund. We'll get started in just a few moments. Give them one more minute. Good evening, and thank you so much for joining us for our February edition of the Founders First Fireside Chat series. And our keynote speaker this evening is Ms. Kesha Cash of the Impact America Fund. And we're going to get started here to give you some background. First, this would not have been possible without our sponsors. We hold these monthly, and our sponsors are, our program partners are the Small Business Development Center, as well as our bank partners are US Bank, Pacific Western Bank, Union Bank, and Wells Fargo. And the goal of this series is recognizing that founders need assistance with how to fund and grow great businesses. And so we started this series from the opportunity to spotlight some of the leading innovators that are funding diverse founders for growth. Before we get started, I'm going to give you an opportunity to get to hear and know a bit about our keynote speaker. As I shared with you, I am Kim Folsom. I'm the founder and CEO of Founders First Capital Partners, and we are a leading revenue-based investor focused on diverse founders. And on the other side, we also have an accelerator that is designed to help fund and grow businesses led by diverse founders. I founded Founders First after 6 companies, founding, growing them, and taking them to mid-market and exiting, and found that there just needed to be, more diverse capital. That was the decision-making was made by a diverse founder in order to increase the number of mid-market companies. And along this journey, I've had the benefit of meeting a bunch of fabulous people that have helped guide, advise, encourage, motivate, and inspire me. And I could that best describes my fantastic relationship with Ms. Kesha Cash. She is the founder and general partner at the Impact America Fund, and recently closed her second fund, the $55 million fund. And we're going to talk a little bit about her background. As I shared, Kesha is the founder of the Impact America Fund, and she just closed her $55 million venture. Prior to that, she was also the co-founder of, I'm going to Jalaya Ventures. Is that correct, Kesha?
Close, Jalia.
Jalia Ventures.
Uh-huh.
And prior to that, just had a number of achievements. I want to make certain you know just how much of a badass woman that she is. She was selected as Fast Company's 100 most creative people in business, a top 5 game changer for Forbes, Power Investor by Essence Magazine, the subject of a Stanford Graduate School business case study on forming a successful impact venture firm. She is a graduate and a co-STEM graduate, so I want to give you props there, and applied mathematics from UC Berkeley and an MBA from Columbia University. One of the things we're going to talk about is the stats with regards to, one, women in business, but the other, the impact of women investing. When you look at some of these stats here, and I shared this with you as we kicked off our series last month. As we know from the CARES Act, as part of the STEM, as part of the recent pandemic funding, there are 30 million businesses that are defined as small business. And of those, some 13 million are women-owned business. And of those, 6.5, almost half of the businesses that are held by women are led by women of color. While that's such a large group, when it comes down to women actually funding businesses, it's actually a very, very small group. And then when you go through and look at the number of women of color in venture capital, it's even smaller. Just to quickly give you some highlights, over 15% of angel investors are women, but only 11% are partners at venture funds. And that's, I would say, largely white-led funds, that's the statistics around that element. When you look at investing in women, there's, well publicized that a very small percent, more than 92% of the venture capital dollars goes to businesses led by women, or excuse me, led by men. And then when you look at the gap as it relates to dollars that go to a diverse team where there's a woman founding the team, less than 13% goes to businesses where the woman is on a founding team. So a larger number goes to mixed gendered businesses. We'll have to get insight from Kesha about the actual number of diverse founder funds. And there's a number of folks that are raising funds, but when you actually look at those that are operating funds, I want to say there's probably at best maybe just a couple of handfuls at best. Next slide, please. And next, we're going to go through and talk about Black-owned, women-founded businesses. If you look at that 6.5 million, of those businesses, a growing portion of those are Black female-owned businesses, over 21% of the businesses. And that's compared to 14% of the overall Black US population. The Black-owned business market overall is a growing area. And then when you actually look at specifically the number of Black-owned businesses, it's over 2.7 million of those businesses. With all of that, they're growing at a rate of 7% year over year. But the challenge when you look at businesses led by Black women is the annual revenues. That was the driving factor why I joined, went on the other side of the table from being an entrepreneur to actually being on the other side of investing in businesses, is to change this statistic and increase the number of Black women, military veteran, and other diverse founder-led businesses. So with that, I'm gonna pause here and share with you again about Kesha and her experience, because she follows these buckets. She's a woman, Black woman, American, immigrant, investor, and leading the charge with Impact America, being a bridge and the cultural divide that have kept low and moderate income people of color on the sidelines in the economy. You can go to the next slide, please. With that, let's go ahead and just start the conversation. Welcome, Kesha.
Thank you, Kim.
So
Nice to be here.
thank you. So can you share with our audience a bit about your journey of becoming a leader in investing in early stage ventures, as well as leading your own fund?
Yeah, I'll make the long story short, because I certainly want to have time to answer the most relevant questions for the audience tonight. But I started Impact America Fund after many years of work on, I started my career on Wall Street as an M&A analyst. And then after spending 2 years in New York and a 3rd year in Los Angeles working with smaller, and I say smaller as compared to the bigger $1 billion plus businesses that we were doing transactions for on Wall Street, small lifestyle mom and pop businesses in Los Angeles. So that was exciting to me to really roll up my sleeves after working on Wall Street for 3 years as a mergers and acquisition analyst, to work on Main Street and really dig in deep with small businesses and started to identify gaps in the ecosystem. And this was, gosh, this is 2004, 2005. Started working in Los Angeles, worked with a fashion designer, worked with a hairstylist, and brilliant founders that wanted to scale their businesses. And after being on Wall Street and having access to a lot of resources, I realized that these founders could work every day, all day, 24 hours a day. And unless they had access to resources, to capital, to support, technical assistance, then they wouldn't get very far. So my journey from Wall Street, working on Main Street, led me to Columbia Business School to do more work on my thesis, to understand, how do we get access to capital? How do we build out these networks? And what does that mean for low and moderate income communities in particular? So that journey resulted in me meeting one of my first investors at Columbia Business School. And I started working with this family office to pressure test that thesis. And where we landed in that thesis, or where I landed, was there are opportunities now, and we started seeing founders show up in our pipeline that were using software and technology specifically to scale, to empower, in the case of Maven, that's in our portfolio today, but to empower 50,000 hairstylists across the country. So I got really jazzed and excited about this notion and this idea of, like, how do we serve the community? How do we serve local businesses, and do it in a way that we aren't helping one or two businesses? We can really leverage technology and the power of venture capital in our case to scale that impact as well as those financial returns.
Well, I'm going to break down that a little bit, because that is an amazing story. But as you were sharing your journey, you went to undergrad and Berkeley. So you were from California, and then spent time on Wall Street, and then realized there was this gap in the market. Spent some time doing some analysis as an M&A analyst on Wall Street, then went and really built some experience with your thesis at Columbia in doing that investing. But how did you decide to go from the West Coast to Wall Street? I mean, that is definitely a gap between one to the other.
Yeah, well, I met someone while in undergrad who came back, a mentor, who became a mentor, but he came back from Wall Street. He was an alum of UC Berkeley. He held a quote unquote kind of workshop or seminar for Black and Brown students to tell us about this amazing program, SEO, Sponsors for Educational Opportunity, and encouraged us, if we had, good analytical skills, and were interested in making a lot of money as a young person over the summer on Wall Street to apply. And it was actually, I'm glad you asked about that, but it was through that application process, SEO, a great program that's placed many, many, many talented Black and brown people on Wall Street. And I think are responsible really for the diversity that we do have on Wall Street and in finance. During that application process as an undergrad, applying to work on Wall Street in a summer internship, they asked the question, they said, look, if you're successful in finance and a career in finance and on Wall Street, what will you do to give back to your community? And I swear I wish I had a copy of that essay, and I need to check to see if SEO saved it in their archives. But it sounded like what I wrote then, a sketch and an outline. I had no idea, years later, that I'd be doing what I was doing. But the idea of using finance to create sustainability, economic sustainability and empowerment for LMI communities was a part of my ethos. And it wasn't just an essay to write to get into SEO, but I meant it because I grew up in Orange County, California, but I grew up, economically disadvantaged, so to speak. We didn't have a lot of money, but I had access to great public schools and understood what opportunity looked like. And so, having this great opportunity at UC Berkeley to apply to this program that placed talented Black and brown students on Wall Street was, obviously life-changing for me, not coming from a background of or finance or knew people who had worked on Wall Street. So that was what got me there. And then I figured out how to get there full time after interning for 2 summers, actually, in college. Loved New York, returned full time. And then just to fill in the gap before, sort of after Wall Street, I think what I like to say is I got my first MBA was from Main Street. So the time after Wall Street, before I attended Columbia Business School, I worked for about 5 years on Main Street. And I say on Main Street, this was myself and I consulting small businesses, rolling up my sleeves, jumping into companies, helping them figure out sales strategy, helping them raise some, seed capital from mentors that were at the time were still, on Wall Street and making great money and trusted my wild ideas of investing in these small businesses. So I started doing that work, and it was really the 5 years that I spent actually working directly with companies and entrepreneurs where I got my aha moment of there is talent in the community. There is a willingness and a desire to grow their businesses. There's no lack of effort or willingness. What there's a lack of is an access to the dollars, to the capital, to the resources. So that really informed my thesis, taking my Wall Street background, combining it with my hands-on experience, working with small businesses, and then returning back to business school to build out a network and a community where my thesis for Impact America Fund, we are a venture capital model, but we don't do the work unless we believe, we don't make an investment in a company unless we believe the outcomes of that company will not only generate financial returns, but will leave the community. And when I say community, I mean low and moderate income communities, highly inclusive of Black and brown people, will empower those communities and leave those communities better off than they were prior to that solution being introduced.
Well, thank you so much for sharing that journey. And, as Ben's, had such progress in advancing it, I'm certain that you've probably had so many people ask you, I want to raise a fund. I mean, even though it seems to be so common, people stating that today, but 5, 10, 10 years ago when you were, in this journey, it wasn't as prevalent. So when you think about being able to put together strategies in place to advance your investment thesis, getting your first fund pulled together, can you share a little bit about your first fund and, how you went about it, time, first investments?
Yeah, absolutely. As I mentioned, while I was a student, a graduate student at Columbia Business School, I had the opportunity, I should say, after my summer. So during my 18-month stint as a business school, as an MBA, that summer experience is really important to kind of validate that you want to do what you say you want to do. And I chose to spend my summer in London at a impact investment firm called Bridges Ventures. And now there's a Bridges Ventures in the US. At the time, there was only a Bridges Ventures London. And so I went to London for that experience. And that experience was exciting because Bridges Ventures was focused on investing in underserved areas of the UK and using the rigor of finance to do so. So the folks at Bridges Ventures in London, when I spent my time there, were people that had worked on Wall Street and private equity, and they were choosing now to build a firm that used the rigor of finance, but to do so in a way that was empowering for the community and identifying opportunities to invest with an impact lens. So after that experience, I said, aha, this is what I've been talking about. I didn't have the language for it, but this is it. And how do we build something similar here in the US focused on the communities that I care deeply about? And with that thesis, I came back to Columbia Business School after my summer, and I met a gentleman, Josh Melman, who happens to be, a part of the family that endowed the Melman School of Public Health at Columbia. And he had been doing and continues to do, quote unquote, impact investing for 30 some odd years. So he's an angel. He managed money at the time on behalf of a very, very wealthy family office. He himself was investing his own dollars. And we met and we talked about, what I had experienced prior to business school, working with small businesses, why I'd come to business school, what I had done that summer in London. And he responded saying, now's the time. He's like, I'm tired of people. And now Josh is a Jewish white man who's older than me. But there is this connection point of him saying, I'm tired of people paying lip service to saying they want to invest in diverse founders. If you can find them, let's move the money. And that's what we started doing. So in business school, my last semester, I paid attention enough in class, but I spent the majority of my time working with Josh Melman, building what Jaliyah Ventures was in a real fund. It was a name that we gave work that we were doing off the balance sheet of a family office that he was the face of and managing money on behalf of, and also included some of his investments. And that's how the fund started, kind of the first iteration of the fund. So we did that work. And before I graduated, he's like, I know you're passionate about this. You want to do this. You don't really have a track record to raise a fund. If you want to keep doing this work, give me a budget for the next year. We'll keep making these investments and they will come. That time will come. I said, absolutely. We agreed. I signed up for a year. That year turned into 3 years. And at the end of the 3 years, when I was ready, I rolled off sort of out of that family office and established Impact America Fund 1, thankfully with their support. So they anchored, they were one of the anchor investors in my first fund, along with 9 other investors. Our Fund 1 was a $10 million fund, started raising that in 2014. I think our final close was in 2016. And then, we chipped away at deploying that capital, managing a $10 million fund. Doesn't give you a lot of resources in terms of team, but we survived that. And then last year closed Impact America Fund 2, the $55 million fund. So now we started out with a team of me, a part-time person, and a lot of interns. And fast forward, now we have a team of 6 people, 5 of which are full-time. So we've made some good progress.
Fantastic. Well, I know we're going to get into your portfolio in just a bit, but in the Jaliyah Ventures, the first fund, can you share just for an overall number with Jaliyah Ventures, when you were first involved with that, how many investments you made, and then your first fund, how many investments you made? Yeah,
Jaliyah, we were thankfully, I mean, we were able to look at things through a very wide scope. And so what ended up happening, I guess, over the course of those 3 years, I was directly responsible for investing about $5 million of capital. And this sat within kind of a $50 million portfolio that Josh had been building. And then I supported some of the work with the larger portfolio. So out of the 5 million, I think we count, there's probably about, 10 investments, maybe 10 to 12 investments out of that 5 million. Mm-hmm. And then the cool thing is, because those investments were pretty early, these were super early investment, seed investments, a couple of them were ideas that it started, and Josh and I were like, we like the founder and we want to learn more about this space, and we think this person's the one to figure it out. And so we were able to move pretty quickly on some companies that were really early. So by the time I was ready to raise, by the time I raised Impact America Fund 1, a few of those companies in the portfolio had matured and they were ripe for investment out of Impact America Fund 1. So that work not only gave me experience building my muscle in regards to how to identify, source a deal, diligence a deal, get a deal done legally through the legal process. All the deals were legally done, but get through our legal process and then provide support to those companies. So I learned that process over that 3-year period. And then once I raised Impact America Fund 1 and we were looking at, the pipeline of deals, the first 2 deals that we did were out of Impact America Fund 1 were 2 companies that Josh and I had funded through our work together with Jolly Ventures. So $5 million over 3 years, and then Impact America Fund 1 was a $10 million fund. So I kind of doubled the size of what I'd done. And then, thankfully, fast forward Impact America Fund 2, we kind of 5.5 times that size.
That's fantastic. Fantastic. Wow. And I want to point out for our audience the journey that you went through from 3 to 2 to get to the next one. As so many people go through and say, hey, there's a problem, I'm going to raise a fund. But it takes time, as you and I have talked offline about this. Before we get into some questions, I want to ask, just looking at the whole, you got into this in the teens, you did this, pre-2014. So you're when you were in grad school, that was in the 2010, 2011, 2012 timeframe.
2010, yep.
And so this was before the current thing that's happening right now, where you've got all these initiatives with regards to diversity inclusion. There's been major announcements with regards to, changing the landscape, where people have just become, or I should say, marketing wise, have said, their commitments with regards to this. How, in your view, when you look at the work that you've been doing for, almost 10 years, can this move beyond the marketing and philanthropic perspective to actually advancing the work that you're doing?
Yeah, I think we're getting there. And I'm glad to see so much activity, right? And there will be a shakeout, and we'll see, which PR campaigns turn into real long-lasting sort of sustainable change. But I think the work that I and many others were doing in 2010, and really work that predated the work that I was doing in 2010, like you said, like these cycles and waves have come before. I think, the difference this time is that I feel like there's a real kind of intersection of grassroots activist movements, people coming out of finance, such as myself, people coming out of industry. And it seems to be this more collaborative nature of different folks coming together and saying, hey, we have what it takes to create sustainable change within our communities. Now, the PR campaigns will happen, the corporate initiatives will happen, the foundations, which I love, they're partners in our fund, will, promote their programs as well. And I think the work is on all of us to make sure that we aren't getting caught up in the hype, and that we are gathering and deploying resources responsibly and doing the best that we can to harness, the power of this movement. But I do believe that, it really started as a movement. We were looking at some old videos and press and kind of archiving our own talks and things we were talking about in 2017. It's the same conversation today. The difference right now is that we have people's attention. And I think while we have people's attention, honestly, we run as fast as we can. We try to do as much as we can to embed the energy and to create systems and flywheels that propel themselves, so that we're not kind of waiting for the next moment for a handout, but we're actually creating long-lasting, sustainable change. So it's an exciting time. There is a lot of noise. You kind of don't know why somebody's doing something or what their intent is. And I think I've gotten to the point where, as long as it's not directly harmful, if it's a PR campaign, let it be a PR campaign. What do I need to do to make it real for the work that I'm doing and for the communities that I care about?
Well, thank you so much for sharing that. So we're going to now go into a bit more detail with regards to, a few key questions, and I know that our audience has always asked about. So I'm gonna prompt my team to, there is a poll that we're gonna ask to share amongst the group here. And I ask the audience to participate in a moment here. If you could share amongst, for the next portion of our conversation, we're going to talk about, we've talked about one of these items, but the other three items. One is how to become an investor in diverse led companies. Second, we're talk about how do I determine the right type of capital, be it debt, equity, or revenue-based financing or crowdfunding to grow my type of company and my stage of business. The third question we're going to talk about is how to attract the right investor to support my business growth. And then the fourth one is how to determine the right amount of capital to raise for my type of company and my stage of company. So I'm going to ask that you please take a moment to participate in this poll. So if you can go through and do that. We'll give you one moment here, and then we're going to get back and discuss these topics further. This would be great to have some Jeopardy music. All right, we're going to give it one more moment here for folks to complete the poll. And then, okay, so let's go ahead and take down the poll, please. And then you can go ahead and take down the slide as well. When you think about your deals, you've gone through and you mentioned the number of deals that you've done. And there's, you have done, more than a couple dozen of deals when you look at, your body of work over the last 10+ years, and now you're into your second fund. I want to talk specifically around a couple of deals. One is the Connex company, and then the other is the Maven company. And when you think about those two, let's start with Connex. How did you find them? Talk a little bit about what they do and what made you decide to invest in them.
Yeah, and the name of the company is Connexus.
Connexus.
No problem. No, it looks like how you pronounced it. So it's interesting enough. Connexus was one of the companies that Josh Melman and I seeded at the very, very early phase in 2013. And that company was led by a Black male founder who had spent about 10 years in the procurement space. And the company actually started out as a consulting business based in Mason, Ohio. And after he transitioned out of working in corporate procurement, he saw the need for companies to have more access to diverse suppliers. He's like, look, it's a check the box sort of thing when you're in these corporations. They're not really sort of in a position or set up to look far and wide for diverse suppliers. The same suppliers get access, or you have your contractors subcontracting, and it's network. It's a tight network. And so, all the stats show the greatest way to expand for minority women, minority-owned, veteran-owned businesses, Black and brown-owned businesses, to expand is to get a corporate contract.
Right. And then use that to get another one and
right.
another.
Right. And that flywheel, getting a corporate contract, you're going to expand your business. You hopefully create more jobs. And if you create more jobs, you're hiring people from your local community. And if you're a woman, Black or brown, you're a veteran, you're hiring people in your network. So then that creates more opportunity for Black and brown people in the case, or in women, in the case of how Josh and I were looking at the company. Now at the time, I think they had a pilot happening with like one client, but they didn't have any real revenue in 2013, no real revenue. But the founder, Rod Robinson, was passionate about this space. He had the decade of experience doing the work in procurement, and he understood, what the problems were. He had met some early stage investors in Mason, Ohio, that nudged him and said, hey, look, like, we love that. We think this is real. Think about technology. How are you applying technology to this business model in a way that you can scale beyond, one or two clients, but really turn this thing into a software as a service platform where you're paid on a subscription basis, and your tech is doing the work for you at some point. So we were early seed investors in Connexus. That was one of the companies, once I had raised Impact America Fund 1, that one of the first investments out of Impact America Fund 1, I think they were raising either seed extension round. They were raising more money. It doesn't really kind of matter what the round was. And they were still pretty early demonstrating their model. So we invested and then continued to invest money into that company. Interesting enough, that company, and this is, like I said, in 2013 is when we made the seed investment. Connexus sold last year before the racial uprisings, which we think our timing was slightly off. No one knew what was coming. Sold to Coupa, which is a public company, a large public company in the procurement space. And so now Connexus, if you look up Connexus, it's still live. Connexus, a supplier diversity procurement platform, is now embedded within Coupa. And what I'm told by Rod, given the events of 2020 and the corporate focus now on diverse suppliers and stakeholders, Connexus is a really important aspect of Coupa at this point, which is great.
And it's so important because there's the three pieces that, we talk about. Capital's one, but a channel of consistently access to customer corporate contracts is critical, so critical. So
and I'll add right now, Kim, and I see a note. What are the three things small business can do to maximize this opportunity right now? And we're seeing it for some of our companies, Maven, I know we'll talk about next, and others. But corporations are looking for diverse suppliers. They're looking for diverse brands to promote. So I think right now our company, Maven, that we'll talk about, and Maven's, again, a tech-enabled platform, but they're bringing on, as an example, they're bringing on a part-time consultant for biz dev around these corporate opportunities that exist. So I'd say, one thing that can be done is paying attention to what those opportunities are, finding someone in the space that is paying close attention to that, and finding opportunities, to get into the mix on this momentum that's happening now for diverse businesses.
Well, thanks so much for sharing that. Going back to the three questions, in addition to equity capital, which you guys invested in, and did this particular company, did they have any other alternative types of capital? You said you met them, they were pre-revenue, and then by the time they sold last year, you were with them for some 8 years. So their journey, because that's the other misunderstanding people have, is they think they're going to just get one infusion of capital and poof, everything happens from there.
No, there was a journey. You should actually have Rod Robinson. You should have him come and talk about his journey, and honestly to talk about what Coupa is doing now, because I think it'd be quite relevant to your businesses that you work with. But no, I honestly, I wish, Kim, your platform was around along the Connexus journey, because I think there are opportunities for the company to finance itself in different phases, in different ways. And that venture capital, and I'm a venture capitalist, but venture capital certainly isn't the end all be all capital. And sometimes it doesn't make sense. It's capital that doesn't make sense to take. You're diluting your equity, you're diluting your ownership. And if there are ways to introduce different capital in the capital stack as a company grows up, then that's the more sophisticated way of thinking about financing. I believe they received some capital, some debt capital from an innovation kind of agency out of Ohio. There was some debt on the books when they sold, not a lot of debt, but I do think, kind of 2020's hindsight, Rod will tell you as well, kind of looking backwards, if to do it over again, there definitely were opportunities to finance the company in different ways that would have resulted, in kind of better outcomes for all at the end of the day. The company did well per its exit. Some investors, being quite honest, did better than others because of the type of when they came in and kind of the structure of that capital. So the capital structure certainly matters.
Yes, it does. And it's just as you mentioned that now he's on the other side of that, having been on the other side of 3 exits. That's why I'm doing what I'm doing. What I do, is that having having our audience understand that there's not just one type of capital to grow a business. You need multiple types of capitals at different stages, and and that those different capitals will definitely have an impact on what you end up with. I'm saying from a founder standpoint, using that hat and that lens, that it's not just all about the equity. But I'll just park that for a different conversation. How did you happen to meet this founder? You talked that you began working with him very early. That was a lot of trust and respect that he had to build with you. How did that happen?
Yeah, we met the founder. I was introduced to Stacy Philpott, who's now a famous lady in the space, and that her last gig, I think she just stepped down last year, but she was the CEO of TaskRabbit, a Black woman, one of the few Black women to be CEO of a large tech company in the Valley. Stacy at the time, prior to joining TaskRabbit, was a entrepreneur in residence at Google, where I believe she had worked for a while, and she was kind of toying with, at the time, the venture capital side of the work, and/or becoming an operator, a CEO. And so she took the operator CEO path, but she's a force to be reckoned with. But Stacy's husband, I believe, knew or Rod from business school. I think they both went to Wharton Business School. So there was this kind of long-term connection there. And during kind of just a meetup, a coffee chat that I was having with Stacy, she mentioned, she's like, I have this friend my husband knows, and he's a friend of the family, and he's doing something I think is really cool. Let me know if you want an intro. And that goes a long way, because Stacy's someone that has a fantastic reputation, and we had an opportunity to connect. And so she made that intro, and birds of a feather flock together. She was good people. She introduced us to good people, and Rod came out to New York. I had met Stacy. I was living in New York at the time. I met Stacy in the Bay Area. Rod was in Ohio. So Rod came out to New York, and Josh and I met him, and we're like, we know very little about procurement and how to build this thing. But we love the vision that Rod has, and he seems like an amazing person, and he proved and he still is an amazing person, an honest, hardworking visionary. And so we invested early. Mm-hmm. And that's how that went down. And then, over the 8-year period, we obviously deepened that relationship. There were good days and bad days. There were challenges, there were wins. And so now, I would consider Rod will be a part of my network, and hopefully he considers me in the same light forever. Like that relationship, what started out as a transaction, a seed transaction, turned into a very meaningful relationship. And I expect, as he grows at Coupa, it digs deeper, and it scales and expands the offerings of Connexes. And as we continue to do our work, I expect there are going to be opportunities for us to co-collaborate again.
That's great. Well, I want to ask, I guess, further, how, as diverse founders, one of the challenges is the social capital and connecting with, the Kesha Cashes of the world. So, when you think about, some of the things that you're doing with your new fund, which is 5 times what the other one was, what are some of the avenues that you're actually building those networks that are feeding your pipeline of deals today?
Yeah, the biggest one is showing up at talks like this, Kim, and meeting people who are managing capital and organizations that are in alignment with what we do, but are different, honestly, than what we do. And so constantly meeting new networks of people. We obviously have co-investors that we've invested with a few times, and if they see a deal that looks like something that we would invest in, they'll share it with us, and likewise. So we have that community of co-investors, but we know most of the co-investors that we invest with aren't Black and brown people, to be honest, and there are more coming, and we're starting to do deals. But then we know, if we're missing opportunity, we're missing the opportunity to identify best-in-class founders because they're not a part of these networks. And so we're intentional about showing up outside of even the networks we built, right? We built strong networks with people that care about impact investing in a way that's different than just, investing in Black and brown founders. Like, we're looking for that next level of like, are we creating financial opportunity for the community? Are we, empowering the community through skills training? So we're looking for that additionality. Everyone's not necessarily doing that type of work, and they may be doing it in a different way than we may be thinking about it. So we don't ever want to lose sight of, we know what we know, but we want to meet other people that are closely aligned so that we can learn and grow and hopefully find those opportunities that we otherwise wouldn't know about. So we have our close knit community, but we're always looking to build that community to make sure that we're staying, we keep a fresh perspective on what's actually happening out there.
Well, it's been a sheer delight with our alliance with between our organizations, and to present and refer quality deals to you guys to consider. One other thing, when you look at how your lens with regards to the stage of deals have changed, have you gone and you looked at more deals that you're doing today? Are those deals, in revenue as opposed to pre-revenue today? As far as the stage, how has your investment thesis adjusted?
Yeah, thankfully, when we first started the work in 2010, when Josh and I first started the work, like there wasn't a lot of focus. And so over the years, over the last decade, thankfully, there's more of an ecosystem. There are more early stage investors. And so our firm now, we rarely seed an idea. Like, we'll invest after a company has raised seed stage capital. And we feel good about that because there are more and more accelerators and ways for people, still not enough, but ways for people to raise that first early stage check. And so we're now filling another gap. Once companies raise the early stage seed check, there's often a gap between that money and them being able to raise. There's a time gap and a funding gap for them to go out and raise a Series A round, which is their first kind of large institutional price round. And then what happens? What happens? You raise a seed check, but then you don't have enough traction to get to your Series A round. You run out of money along the way, and many companies do. And so we play now in this role where we consider ourselves bridge investors. We're bridging from the seed check and the seed raise and that first, oftentimes that Series A raise. And typically, if we're doing kind of a true bridge, a company does have revenue already. They're generating revenue. We're seeing opportunities now, and it's quite amazing. So, threshold used to be, is there at least, $500,000 of recurring revenue, kind of 12 months, 12 to 18 months before they're going to raise a Series A round. That bar is, for better or for worse, is getting a little higher. So we're seeing companies now that they're generating $1 million plus in revenue. There's a company we're looking at that's about to raise, in the process of raising her Series A round, and she's already generated $3.7 million of Series A, or of revenue before she raises her Series A round. So we're seeing companies that have more traction than what we saw in 2010. And I think that's a result, thankfully, of an ecosystem that's been building, and they've been able to at least raise the seed money to get that early traction in, Black and brown founders and women are typically quite efficient with their capital.
Yes, we can do a lot with 2
And
cents.
so a little goes a long ways. And it's interesting when we meet founders, some of our founders are like, look, you had to, and I had to do the same thing. You had to do what you needed to do to get here. And you had to be really scrappy and efficient. But now you have to start investing. Now you need more cash. You need to invest. You need to grow. And it's interesting, the skill set that gets you to a place of being, frugal and efficient could hinder growth if you're not careful and letting go and like investing resources and managing more money. So we tend to kind of have the opposite problem where our companies, our founders have had to be so efficient that now it's like, okay, now what do you do when you have $10 million on your balance sheet to work with? Which is a good problem to have.
Yeah. Good problem to have. So now let's talk about Maven. How you met them, what's been your, what stage did you invest in them? And talk also about the business, because I'm certain our audience may not be as familiar with them.
Yeah, Maven is a company that leverages the power of technology to empower independent hairstylists. Maven 1.0 started out by enabling hairstylists to essentially have their own online store, whereby hairstylists, instead of recommending a client to a corner beauty supply store, they'd recommend a client to their online portal, and then per each sale, the hairstylist would earn a commission check from that sale. And so that was Maven 1.0. Maven 2.0 has really transformed, in terms of understanding stylist needs and customers' needs, and has turned into, and there's more coming, but essentially, a maxing platform whereby the Maven stylists are a part of the Maven platform, and customers, when they come and buy, a hair extension product, can choose to also buy that with a service, sort of a package deal that overall would be more cost effective than buying both, and buying the hair and then choosing the service. And now if you go on Maven, you buy your hair within your zip code, Maven will match you to a Maven stylist that will then quote unquote install the hair for free. And so the economic model has been structured in a way where the customer who is buying the hair and getting the service wins, because overall net it's a cheaper, quote unquote, high quality but less expensive, I should say, overall package. The hairstylists or hairstylists that would otherwise, they had additional capacity, and that's what Maven discovered through Maven 1.0. There are great hairstylists out there that aren't, filling the capacity of their work week. And so if Maven can fill that capacity, heck yeah, they want those new clients. And then Maven wins, right? Maven isn't a brick and mortar store. Maven is using technology, so it can offer better competitive prices because it doesn't have the overhead of brick and mortar. And the investors invested in Maven because the hair industry is a very, very big industry. Black and brown women particularly drive the sales of that industry. But we invested because it's big, it's fragmented, there's a large opportunity. But when you peel back the layers, we know this in the Black community, we have been contributed to this industry for a very long time. And unfortunately, since the days of Madam CJ Walker and the likes of her, fast forward, we have very little ownership, but we represent a large percentage of the business and the revenues that are being driven. So Maven sort of disrupted, quote unquote, not rocket science. They didn't do anything that wasn't already being done, but they've leveraged the power of technology to drive efficiencies, to drive down costs, and to drive scale for hairstylists.
No, I think that's just fantastic, and so many multiplier effects with regards to that. So at what stage did you begin investing in Maven, and how had, when you look at that investment based on 10 years back, would be interested in hearing your perspective with regards to that.
Yeah, I actually started tracking Maven. I met Maven during that period that I transitioned in New York when I was working with Josh Melman in the family office. When I transitioned to raise Impact America Fund 1, someone who became my investor actually, and others had mentioned Maven, and I hadn't heard of the company. And they're like, this great entrepreneur just pitched. at, I think it was a 500 startups demo day. One of my investors, before they were my investors, said at the time, they're like, we don't know anything about hair, but this founder was fire and had a great pitch. Prior to business school, one of the small businesses I worked at in Los Angeles was with a hair stylist who wanted to build out his own line of hair products, which took me on an adventure to China to explore factories and to learn a lot about hair extensions. And they knew that from my background, and they were in the process of looking at investing in Impact America Fund One. So they sent me this opportunity, like, we don't know anything about anything, but we think this founder is fantastic. You may want to diligence the founder. And when I met Deshaun, the CEO of Maven, I didn't have any capital to actually invest in him. But I told him my background story, and I was like, look, I'm going to raise this fund. In the meantime, let me introduce you to some other people with money that may want to invest. And then I started tracking him. So I'd show up at his office every other month while I was raising the fund. And every other month that I didn't actually have dollars to invest, his revenues were going up and up and up. And this was pre-Series A. So thankfully, I got my fund closed, the first close of my fund, and I had capital to invest in late 2014. So we're actually able to invest in the company. A very intentional bridge round that he raised to have cash on his balance sheet before he went and raised his Series A round, which he raised within 6 months. So that following year in 2015, Andreessen Horowitz led that Series A round. So it's one of those companies where, you know, I still wish that I had capital when I first met them, so I could have invested much earlier, but given the larger scheme of things, and look, I started this conversation with Deshaun about investing in 2013. We're 2021 and we're still in, and Maven continues to grow and pivots and is finding their way. So it takes time. And you know, what we call is like, how many bites at the apple do you get? Mm-hmm. And most of the time you have a few bites at the apple because there's not a straight line from C to exit.
Right. Well, I mean, and that's the thing that, you know, that the audience needs to understand, that it is not an overnight success. It takes many, many, many years. And they just recently, I guess, closed their Series B round, I think it was.
Not recently. They closed that round, gosh, it had to be 2 years ago. And okay. I should know, time is flying. So it's definitely pre-COVID. And thankfully, we had cash on balance sheet to get us through last year. So 2.5, almost 3 years ago. And that round was led by Rich Lou Dennis, who sold. So it was right after, not too long after Sundown sold to Unilever during that time frame. But Rich Lou Dennis, thankfully an industry veteran, has done, obviously knows the hair industry and the beauty space quite well. So he led that round and is, you know, now a board member, which is fantastic.
Couple questions with regards to that, just again, to educate our audience, because I think so many people have they need, I guess, some additional clarification. We talked about seed rounds and how the things have changed in Series A rounds. What are you seeing as far as the size of the amount of amount raised by companies that are seed versus Series A?
Yeah, and it really depends, right? So we're seeing, you know, some seed rounds that are big rounds. If I guess the investors believe like there really is like a proprietary technology and it's a, you know, huge total addressable market, and there's still a lot of white space in the market. So we're seeing some sizable seed rounds at some pretty healthy valuations. Now, on average, I would say seed rounds are typically anywhere from, you know, a couple of $1 million up to about $5 million. I would say is on average. And then Series A, and again, it depends on the industry and how capital efficient the company is. Right. If there's revenue, look, for founders that have revenue and they don't, and their burn rate, how much capital they're spending, how much money they're spending over how much if their burn rate is pretty low, we don't advise them to go crazy and raise a $15 million Series A round. Like, you know, why dilute yourself? So it's this art and science of how much money do I need to get to the next phase? How much money am I making that I can reinvest in the business? How much equity do I have? How much equity do I need to give up for the money that I'm raising? So all of that has to be thought out very, very well. I think, you know, one thing about the hype and the noise that's happening now, it looks really sexy to go out and raise 10, 15, $20 million of venture capital. When you're in this for 5, 7, 8 years, you're looking at how much ownership of your company you have. And the sexier side is making sure you have enough ownership. So if you exit your company at $50 million, $100 million, $250 million, most companies will not become billion-dollar exits. We hope some do. That's just not the case. But so you want to make sure you own enough so that when you do sell your company, you actually have money that you've made over the last 8 years of your life. So thinking about that equation, that pie of how much capital you actually need, how much are you making, how much equity you have, how much equity you want to have at exit, and being realistic about what a fair exit valuation could be per your industry is work that we're now expecting. If founders come to us and they haven't done that work, we're not as interested, because we know after being in this for 5, 6, 7, 8 years what the outcomes are if you haven't been thoughtful about that.
That's really true. And that's where it gets into the whole idea of alternative capital stacks, is that too often, you know, people underestimate how long it may take you to get from one stage to the other. And by the time they get to their Series A, they may own so little of the company, and there's so many different outcomes than, you know, the hockey stick growth. And so when you're trying to go from Series A and may need to go to Series B, but you own so little of your capital, it can really be quite challenging, quite challenging anyway, but it's even more daunting for a lot of Black and brown founders is what I've seen.
Yeah, and honestly, investors want the management team and the founders to be incentivized and to show up every day. So we've seen, you know, cases where founders honestly have given up probably too much in the early days without kind of knowing that they were doing that, or that it would take a little longer and they'd have to give up more capital at the same valuation or more equity at the same valuation. And then investors are hesitant to invest because they're like, hey, if I only owned, you know, a small percent of this company, what's my incentive to show up every day as a founder?
Yep. Well, all great things. And you know what, I definitely am going to have to plan to, we're going to do a part 2 of this next year, but let me ask you a few other questions that are generally my things that are so important to inspiring other folks. So when you think about, here you are, Miss Kesha Cash, second fund and all of this, going back to the 21-year-old Kesha Cash, what advice would you have given her about her future?
Oh gosh. It's so interesting. I actually talked to a group of students the other day, and that there was a question that came up similar to this. And honestly, you know, I think about where I'm at and the ability I have to move capital in a way that matters to me and the communities I care about. Like, I wouldn't want to be doing anything else from a work standpoint. So I feel really good of landing here. I think and when I was 21, and this is what I told the students, like, I was quite stubborn, like. So I was fancy. I was working on Wall Street. I was making a lot of money as a young person. And then when I transitioned, you know, I thought I knew a lot, and I did know some things. Like, I have skills from that experience. But I knew very little about what it actually takes to build a company, grow a company, until I started working with small businesses, and then the light bulbs went off. But it took me a while to come to a place where I realized, hey, if I want to do this work at scale and to affect hopefully larger numbers of people and to really try to transform communities, I need help. I can't do this all by myself. So when I was working in LA with the small businesses, I was a one-woman show, and I had a lot of fun being a one-woman show and working with founders, et cetera. And then I reached a point and I was like, I don't know as much as I thought I knew, because if I did, like, I'd be there already. And so having the humility of being like, okay, what do I need? What are my assets? What are my strengths? But what are my weaknesses? What are my areas of growth? And that took me a while. So I was an older student by the time I went back to business school, because I thought I knew and I was going to figure it out on my own. So talking to my 21-year-old self, it's like, be bold and be courageous. And I think I was at 21 to work on Wall Street and then transition to do something that most of my friends thought I was insane about, working with small businesses after working on Wall Street. But while being bold and being courageous and being entrepreneurial minded, I would have sooner than later built out my ecosystem and found partners and found advisors and really found people to support me on that journey. Like once that clicked for me and I was like, oh, you know, this is what I really want to do. Then, and when I was open to receive that guidance, then I started, you know, then I got the internship at Bridges Ventures in London. Well, first, thankfully, Columbia Business School accepted me. Got the internship in London, did that. And like, as a student, learning from the best of the best, in my opinion, came back, met Josh Melman, learning from the best of the best. And so once I opened myself up to learning, you know, things moved a lot faster for me.
So it's the fact that being open and receptive to expertise to help you get to where you want to be. Yeah, thanks so much for sharing that. How do you use mentors and advisors to support your personal and business objectives?
Yeah, I mean, it's everything to me. So we're still a small team of 6 people. I have, and you know, we don't need to talk about it publicly, but I have some of the greatest sort of VC minds that guide and support me. I have formal mentors and advisors. I have informal mentors and advisors. Our firm has a large network of people that we rely on, depending on, you know, if we're looking at something in education where we know what we know, but we're not education experts. So we actually had a call today. We call the people that invest specifically in education technology. And they're looking at this space much deeper on a daily basis than we are. Typically, we're looking at it from a systems change, low and moderate income community standpoint. But we also need people that understand the industry of education and to get us up to speed pretty quickly on how to think about that as an example. So we leverage mentors and advisors around our business, from operationally, like how are we building this firm to make sure it's sound and it's here to stay and we have the right systems in place, to portfolio company support, to we're looking at a new deal. Is this as exciting and as feasible as we think it is based on your lens, to our advisors for moral support, to be honest. So in anywhere that we can leverage good thinkers and support, like we try to do that more often than not.
And so you also have a formal advisory board as well as part of your fund?
We have a governing body. So it's part of most venture capital funds. When you raise money from your limited partners, you're required to have a limited partnership advisory committee. It's called your LPAC. Mm-hmm. And that committee, our committee represents 5 of our investors. We have 67 investors, represents 5 of our investors, but that committee is like a governing body for all of the investors, right? So they're making sure that we're meeting on a quarterly basis. We've chose that cadence. We love our LPs and we have a great time in those meetings. But that LPAC is to make sure from a governance standpoint, we are keeping good order and they're sort of representing the body of other investors. So that there's that committee. And then they've also been fantastic about bringing in resources for founders or companies we're investing in. So they serve kind of multiple purposes. And then we have, we're actually formalizing it now, but we have advisors that have spent really a long time in private equity and finance and venture capital. We have that committee. So when we meet with those guys and women, we're specifically talking to them about our day-to-day work on like portfolio management and operational, getting operational guidance and feedback on how to be the best venture capital firm that we can be. And they're great for that. And they're connecting us with others that they know in the space, et cetera. And then we have a bunch of informal advisors. Like I consider you, I mean, we're peer advisors to each other, but you know, talking to you and getting feedback from you on your worldview and perspective, you know, we consider that as part of our advisory network. Well,
I tell you, Kesha, I am just so delighted with your progress and with your success. And, you know, given that I've been a little bit around a bit, and we have seen this moment happen so many times. And as you and I share this goal of having this moment turn into a movement, in your view, based on the vision of what you're doing with Impact America Fund, what are the critical things that need to happen so that you can achieve the, you know, not the second, you're going to be the Andreessen Horowitz for the market you serve. So, you know, what are the key things that you're going to have to execute on to be able to make that happen?
Yeah, I mean, every day we're like we expect our founders to do. We're constantly, kind of quote unquote checking ourselves, looking at where we're at, looking at the capital that we deployed, looking at the capital that has yet to be deployed, and constantly coming back to our strategy, asking ourselves, is our strategy working? You sort of start with a thesis and an idea, start to move money and invest. You learn a lot along the way. If you're an entrepreneur, you're learning every single day, something new is happening, things are evolving, things are changing. And I think that's thankfully I've attracted a great group of people as my team members who believe in this evolution and constant growth and constant learning mentality, and have a high growth minded mentality, which is important to have if we're investing in high growth minded founders. And part of being high growth minded is this constant iteration of revisiting your strategy. Is it working? The last thing you want to do is try to make something work that just isn't working, but refuse to change and how it works.
Right.
And
that's the definition of insanity.
Right. To keep banging your head against the wall. So that 21-year-old me was doing that. I was like banging my head against the wall, and I was like, if I actually knew how to make this work, it'd be working. So there's a gap between what I think is happening and what actually is. And it's so important to check that insanity. And it's hard. You got to have a lot of humility to acknowledge like this isn't working. So every day we're like revisiting our strategy and looking at, and I think as long as we do that, what we're seeing amazing growth. We're typically ahead of the curve in terms of our thinking, because we're constantly iterating and checking whether or not something we did, whether it was advice to a founder or a strategic move that we were making, or things about this, like how do we hold ourselves accountable? Did it work? Mm-hmm. And how do we know it worked? Did we measure it? And then how do we change pretty quickly if it's not working?
Yeah. Wow. Amazing. Well, I'm excited to be have you as a colleague as we go through this journey together. One last, I guess, formal question I have: what message would you like to share with our audience that we may not have covered as far as our conversation tonight?
We covered a lot in this, Kim. And I know there's a question around ESOP, which I think is exciting because we are starting to see momentum in the ESOP market, and I know that it is uncomfortable. So I want to make sure we get to that. I don't have a direct answer, but you're not off track for looking at that as an exit opportunity. But I'd say, related to this question about ESOPs is, we're at a time now where everything's changing and changing very rapidly. I know very little about SPACs, but every day in the news, you're hearing about SPACs, and somebody's raising a SPAC and they're taking companies public, So I think right now it's just an interesting time at innovation, that there are different ways to get to your outcome without following a traditional path. And I would say to explore those ways and be thoughtful about how your business is suitable for that way, right? So I think the message that I'd like to leave that we haven't talked a lot about, but this is what you do, Kim, is that it starts with being honest with yourself. So us as a $65 million impact investment fund, and we're thankful we're co-invested with some of the great, top tier investors, but we're fooling ourselves if we think we can move like a $4 billion fund, right? And so we have to like acknowledge where we are. We have great goals and ambitions, but like, what's our strategy? What are our assets, and which way do we need to move to solidify our positioning in the market? And I would say the same for companies. What are your assets? What's your unique competitive advantage, and what roadmap from a financing standpoint, from an exit standpoint, what makes sense for you? So I love this idea of your plan to exit as an ESOP. And you're not going to have a lot of traditional investors that get on board, but thankfully, guess what? There are a lot of folks now talking about ESOP. So you have to find those investors and those organizations that are focused on ESOP. And I think we can, and I've done it before, we can get in the habit of trying to convince people, trying to sell people our story that they'll never buy. So it's like, forget about that. Like, they don't want it, but there's some people out there that do want it. And us as an impact fund, we've experienced that. And so, part of it is, some people think we've raised the capital we raised because of our impact orientation. And I'd say yes, and it's because we're also quite rigorous in our thinking. We have, the data to back us up in terms of our ability to get through these due diligence processes. But there is no part in our journey where we're like, hey, we don't want to be called an impact fund. We're like, no, this is who we are. And if traditional investors are afraid of the impact or think it's too soft or think we're giving money away, then that's okay. We'll find our tribe of investors in our funds that are in alignment with who we are. So I think we're at a moment now where there's so many different kind of orientation of investors and people who want to do things differently, that it's a great time to experiment per what you believe your path should be.
That is so true. And, you know, as you know, my journey with raising our funds, you have to find your alignment of funds, because as tech entrepreneurs saying, I'm going to go fund Main Street businesses led by diverse founders, it was like, you have to find a new group of friends because that there doesn't necessarily mean that those folks that were funding tech companies are the same ones that are interested in funding service-based businesses. So it's so true. Well, I know that we're a bit over, but I want to thank you so much for the time, for your insight, for your expertise, for your fellowship. I mean, I can't thank you enough. And as I said, this is part one. We're going to come back and do a part two.
Good.
I can't wait to dissect some of the great deals that you've done. So thank you again. And thanks everyone for your time this evening. And I wish you a fantastic evening. Good night.
Okay. And one note, if people are still there, if you email, go to our website, and if you email the info at, we're a small team, so we get all of the emails. I'm not as good on social media and checking my LinkedIn often, but if you email the info ad, if you have a question or want to connect, then I'll be sure that me or one of my team members get back to you. Just put in the note that you were part of the Founders First conversation.
Thank you so much. I tell you, your genuine support is just fantastic. And with that, I will let everybody get back to their Monday evening. Good night.
Thank you, Kim. Thanks, everyone.
Thanks.